Good afternoon, everyone. On behalf of my partner, Chris Winward, and our sales assistant, Sean Gammon, I'm Chris Swift. Thank you for joining me for Shooting the Bull. Today, we're going to talk about the basis market and what it has to contend with what we're going to see going into the future for this year. So let's take a recap of what basis is. Basis is a mathematical equation, cash minus futures, that allows us to have either a positive or a negative basis. So we're going to start with the backgrounder first. The backgrounder still continues to be in a very good position as far as being able to market inventory. He's carrying hefty premiums in the futures of anywhere from $8 to $30 out into the back end. So the backgrounder hasn't really lost anything yet as far as his ability to be able to manage his risk with the futures or options markets. We see that the index cash market here has been moving up, but it's found a little plateau point right here. We're going to get to that in just a second. This is our cash market right here. This makes up the other side of the basis, and put them together. Cash minus futures equals the basis. So again, to the backgrounder, he's still got the premiums out there. Regardless of what may happen, good, bad, or ugly, right now there's premiums to be had in the futures market. And we're going to have some levels in there that it might be beneficial to you when you're looking at this, instead of saying, oh, well, the premiums are, I'm going to go ahead and hedge now. Maybe we don't have to, but let's look at a couple of things. The negative basis to the background is currently perceived as an advantage due to the ability to market inventory at a higher price in the future. We see that back in October, we made a 172.03 low of the index. I think until the index trades back below that we're still in this bull market. So until we see the index trade back below 172.03, and it may take a couple more weeks until we get enough actual physical sales to see that, if it takes place to begin with, then we probably got just a little bit of time. If that were to take place, backgrounders would be urged to assess their risk and move accordingly very quickly. The weekly feeder cattle index shows us here what happened when we topped out in the 2015 timeframe. We had an initial move down, three waves, three-wave move up, and then we started the long bear market. Today, we have a similar situation, just on a very shorter time scale there, but we have made a peak, and we've got a hesitation, and we got a three-wave move down. We have a three-wave move coming back up. What we don't know is, does this top the market and we spend a long movement coming back down to the 155, 150 area, or do the fundamentals remain strong and we start pushing back up as we did in the 2012, 13, 14 timeframes? So when we look at, again, the basis now, let's look at the determining factors to the cattle feeder versus what it was to the background. Cattle feeder has nowhere to go buy cheaper inventory. He's always having to either pay at the cash price, or if he goes out into the futures, he's having to pay a premium to it. That's very detrimental to them, and we don't see much way to get around this right now, but maybe a few things will help us to consider this. One, we look at what we've already made so far this year, and it's been just a little bit under 60 some odd dollars. We see back in the 2010, the very first leap up there was $63.81. Now, we did have a big correction, almost a year and a half correction right here. That's what could happen here. And that's why we're not so adamant to say it's going straight up and never coming back down. We're probably not ever going to say that. But what we want to find out is, what is the propensity of it to move higher from here, or potentially have a correction of that significance. Coming into the spring of the year, coming into the spring of the year, we believe we'll get improved moisture, and we'll probably get some aspects of wanting to expand, but whether or not we'll be able to expand will be a different story. There could still continue to be enough liquidation via cow slaughter and heifer placement that we're not going to grow the herd anytime soon. So that leads me to believe that we're still going to be short of inventory for quite a while going forward. Were the index to trade above 180, which was just the most recent high that we had, I think that the cattle feeder is out there speaking with his wallet going, today is the cheapest price we got cattle, we're buying them today. If it breaks above the 183.16, the previous high, I think it shows us that a new high, a new move to the upside is forming, and we should be moving with that instead of against it. Cattle feeders would be urged to assess risks and move accordingly. So the industry cycle is concluding. Liquidation continues and most likely will until late spring, if not longer. We need moisture and we need a lot of it. We've got some that has come in. Note California. California is right now experiencing a significant increase in moisture. We believe they could be as much as 1 million to 1.25 million head less inventory today than what they were over the last 2 to 3 years. Liquidation has been phenomenal in that area. If they decide to replenish, you can only imagine what 1.25 million head would take to try to replenish those, just that one locality alone. Packing capacity has increased significantly through the modernization and near full employment. They were able to take a lot of those $500, $600, $700 a head profits and make sure that they were able to increase their modernization so that any kind of hiccups that may happen in the future won't be nearly as bad. So going forward, I find it less likely that slaughter numbers could tax packing capacity. Money will be the key factor. All throughout expansion from 2009 until 20, we had money cheaper. The producer was able to go out and borrow more money for cheaper and expand like nobody's business. And today you can't. The price of land, the price of money, everything is more expensive. And the likelihood of being able to expand right now is just not very good. So what we really need more than anything is weather. And if we do start to get some kind of spring showers that begins to improve the moisture, bringing back pasture quality, hay production, that'll all go forward to the next year, being able to hold those cows back with a little bit less problems than what we do right now. With the immigration, birth rate, death rate, and employment to population, it is anticipated to continue to see more mouths to feed with fewer producers to feed them. I really believe that. That's the way it's been going ever since my career started 33 years ago now. And it doesn't look like it's any signs of slowing up anytime. And although beef is believed elastic with consumer discretionary spending habits, both spending habits of the consumer and beef demand appear elevated. So to take away from all this, the basis is allowing for the backgrounder continue to market pretty much as he wants to. We're about $3 higher or lower, finding out what the cattle feeder is going to do and helping to confirm whether we continue to go higher, whether reverse and go back lower. The detriment continues to be to the cattle feeder. Cattle feeder is going to have to buy more fuel at a higher price. He's going to have to buy corn at a higher price, and more likely than not, he's going to have to buy feeder cattle at a higher price. This is going to be a very cost-extensive way to produce beef, and I don't think it's going to slow down anytime soon. So to the cattle feeder, hedge what you can. And although this may be a very big detriment to the cattle feeder in having to deal with these premiums through the options market and through option strategy, we can reduce some of that risk were the market to come back and give you some benefit to be able to benefit from that. But if the market continues higher, we saw back in previous charts what it can do. Again, whether it will do it this time or not, it's a totally different story. But because of what we know it can do, and we've seen corn do similar instances this year where it went almost back to 8 again. So nothing says that this couldn't go to 207 or 220, making some of those really back premiums that look awfully hefty right now look minuscule. So going forward, consider what you can and cannot do. If we can help in any way possible, let us know, call us, and we'll sit down with you. We'll help you work out any kind of strategies that you need to. And we know what some of those strategies can be that might be very beneficial to you and your operation. So I want to end it on that. I certainly do appreciate your time. You can contact us anytime at 615-844-2206, shootingthebull.com, or swifttradingco.com. Certainly do. Thank you.